Hello, Namaskar. The topic for this session is what exactly is this composition scheme under GST and how can traders actually benefit from it in case they really don't want to get into the trap of compliance burden. So this is Anurag and I'm here because as always I'll share the little that I know. You can follow me by subscribing to this channel. So Goods and Service Tax is set to bring in a new regime of business compliance in India. Large organizations have the requisite resources and expertise to address these requirements. However, if you look at the flip side of it, there are many startups and small and medium enterprises that may struggle to comply with these provisions. Section 10 of the GST Act 2017 therefore brings a composition levy scheme which can be availed by a registered person whose aggregate turnover in the last financial year has not exceeded 75 lakhs. So in the draft act it was 50 lakhs, but yesterday in the GST council met and they financed this limit to 75 lakhs. And businesses dealing only in goods can opt for composition scheme. Service providers are not allowed to opt for the composition scheme. However, restaurant sector taxpayers may also opt for this scheme. What are the key features? In terms of eligibility, your turnover must be more than 10 lakhs and less than 75 lakhs. Your tax rate will be a fixed tax rate on your total sales. As far as input tax credit is concerned, you will not get any input tax credit whatsoever. Your place of supply can only be within the same state. Must have zero interstate sales or exports. The moment you have any interstate sale or exports, you are not eligible for the composition scheme. There is no monthly return, only quarterly returns, and billing issues bill of the supply and not the tax invoice. What are the rates? In case you are a manufacturer other than goods notified, central rate of 1%, state or UT/GST rate of 1%, so total 2% is your incidence. If you are another supplier like agent or trader, it's 0.5% and 0.5%, that's 1%. In case it's composite supply of food or any other article of human consumption or any drink other than alcoholic liquor, for example restaurants, eating joints, mess, canteen, outdoor caterer, so it's 2.5, altogether 5%. And remember, a service provider cannot avail of the composite scheme. So let's understand this scheme by how VAT at the rate of 5% would have been applied in this scheme. So under a composition scheme, a trader purchases an item at 25,000, pays 5% VAT on it, and the dealer cost is 26 to 50. Now this input of 1250 will not be allowed to the dealer. He keeps a 10% margin on this. His sales price is 28,875. He charges no VAT. He is not allowed to collect tax, and he collects from the customer 28,875. Nothing on behalf of the tax payable. And what is the tax he has to pay to the government? Whatever is his turnover, 1% of that. Now as a regular dealer, what would have happened? He would have purchased the same item at 25,000. Paid VAT of 5%, that's 1,250, would have taken complete input tax, so it's not his cost, so his cost would have been 25,000 and not 26,250. He keeps a margin of 10% on that, is able to sell at 27,500 and then adds 5% VAT on it, so his selling price also becomes 28,875. And what is his tax payable to the government? Output VAT, that's 1375, which is collected from the customer. He is allowed to do that. He takes an input of 1,250 and pays to the government 125 rupees in form of the return. Here he was paying 1% flat on the turnover and was not allowed to either collect from his customer, and whatever he paid on the input, he was not getting any benefit whatsoever. So that's how the two schemes are comparable. What will be tax treatment for input credit availed when transitioning from normal scheme to composition scheme? So if A composition dealer is not allowed to avail input tax credit. Such dealer cannot issue a tax invoice also, and he will not be able to claim input tax on such goods as well. What is the return filing process? You are not required to maintain detailed records. That's how life becomes easy for you. Return filing is an easy process. Taxpayer only requires to indicate what is my total value of supplies and what is the tax paid at the composition rate. So if it's like 60 lakh rupees and I'm a restaurant, so it will be 2.5% CGST, 2.5% of SGST, and that's 3 lakh rupees that I need to pay. The taxpayer is required to declare his or her invoice level purchase from the normal taxpayer. And what is the quarterly return? GSTR 4, and annual return in the form of GSTR 9A. Very simple. Life becomes at least very simple from a compliance standpoint. What is the penalty? Please make sure that you take the benefit of composition scheme only if you are eligible for it, because the penal provisions are quite severe. If it is proven that the assessee is wrongly registered under the scheme, not fulfilling the required criteria and therefore avoiding taxes, the consequences are dire. You will be required to pay all taxes as if this composition scheme had not been applied from your pocket, plus penalty, which is equal to 100% of the taxes that are put on you. And then in case you are transitioning from a normal scheme to a composition scheme, then you shall be liable to pay an amount. So whatever is the stock that you have on that day and the credit that you have to immediately surrender that, and the balance of input credit after payment of such amount, if any lying in the credit, shall lapse. So that's how the transition goes. And in case a business transitions from composition scheme to regular taxation, then you will be allowed to take credit of the input that you held on stock or in semi-finished goods or in finished goods on the day immediately. So on the transition date, you either surrender or you start getting whatever is the eligible credit under the normal scheme. Any questions? Please leave behind queries in the comment section and I shall be more than happy to answer them. Thank you.